morning, good evening, good afternoon. Thank you very much for dialing in for what promises to be a very, very interesting event where we'll be talking all things India. Without further ado, I'm going to introduce who I will be speaking to, which is Spike Hughes, who leads one of India's very, very interesting and promising public equities funds. I know Spike now for several years, and it's going to be an absolutely fascinating conversation. So the point behind this was India has been in the news quite a lot for a variety of reasons. Whether we're talking about the fact that other markets, emerging markets, especially had a bit of an issue, and the returns in India were pretty good. It was growing, the political uncertainty, etc., etc. But be that as it may, it's a market which is extremely popular. And public equity, especially, is the top of the heap when it comes to people looking to invest. And as I'm sure we are going to hear Spike talk about, is what exactly is happening. So let me introduce Spike and welcome him and ask him to say a few words about what was his story. I mean, how did he get into India? What was the background? Spike?
No, thank you, Dr. Bhaskar. I think to start that, I'll just put some context. I spent 25 years building businesses for other people, asset management companies, and met a lot of fund managers in a lot of markets and a lot of investors over that period of time, and eventually wanted to build my own business. And with so many money managers out there and such high demand from investors, the one thing that I was very clear about was only do this if you can build a business where your reputation will become that you know how to make money for investors. When you're managing third-party capital, you need to know how to make money for investors, and you need to better stand out. And I was always frustrated by that dilemma between everyone wants a high return, but no one wants to risk their capital. So how do you get a high level of predictability and certainty on your outcome, but at the same time get an attractive return? So I took a step back and I just asked myself the simple question: what are the ingredients? You like talking about food with one of your PhDs, I think. What are the ingredients of a successful investment? And my simple conclusion was that number one, you have to find a market that's got a big tailwind. If the wind is behind you, the chance of making more money and with a higher degree of certainty is greater. So you can have a great manager, but if you're in a market full of headwinds, it doesn't work. So you need a market with a big tailwind. Second, if you find that market with the tailwind, you have to have a level of access that most people don't have. Who is the best manager? Who's been the most successful in that market with the most experience for the longest? And third is just to have the right time frame. We're very impatient as investors. Everyone wants to know, what did it do today? What did it do this month? But actually, of the many Warren Buffett quotes that I love, I'm sure many people love to hear. One of my favorite was when he was asked, what's the ideal holding period for a great investment? And he laughed and he said, forever. And of course, that was the power of compounding over time. So if you can find, the biggest growth story, get the best access and be in it for a long time, for me, that's the recipe for making money. So that really was all presented with India. When I look at India today, it's the size of the opportunity, it's the scale of the growth. India's got the best demographics in the world, as we know. It's the largest population, 1.5 billion people. It's the youngest population with an average age of late 20s. Everything is becoming more productive. Spending trillions of dollars on infrastructure. The whole country is on a digital identification. We've had more than 10 years of strong reform momentum now under Prime Minister Modi, and that's really the recipe for trillions of dollars of growth. So forget what I think. The consensus, if you ask the 20 best economists in the world, what do you think is going to happen to India in the next few years? The consensus is that it will create as much growth in the next 6-7 years as it has in its entire history. So in other words, today it's a $4 trillion economy, it's a $5 trillion stock market, but the consensus is that within 5 to 7 years, it will double in size. So for me, that had to spark my interest as someone managing third-party capital.
Mm. Spike, that was an extremely cogent answer, and people frequently forget about the fact that when you're going into public equities, please don't treat it as just something that you dip in and out. It's a longer term play that is very important, and what studies have said. But tell me a bit more about how did you meet with Madhu? I mean, the relationship between an investment manager and the fund manager has to be extremely tight, and successful partnerships like this are just let's just say rare. So bring out the personal side, if you will, please.
So I think putting my children and my parents to one side, Dr. Bhaskar, I think the two most important relationships that I've got right in my life. One was my wife, and who I met 12 years ago, and one was my business partner, or is my business partner, which is who is Madhu, who I met 15 years ago. So I'm English, and my wife is from India. She grew up in India, so people often think that was my way into the Indian market, but actually I was already very passionate about India. So I started to look at India very closely about 15 years ago, and I could see it was the 10th or 11th largest economy in the world at the time. It's the 5th largest economy today. It's the 4th largest stock market today. But I was introduced to Madhu at the time, and in those days he was running the Reliance business, the asset management arm of the investment group at Reliance in India. And I'd met hundreds of fund managers, and I was introduced to that business, and I was told about this, iconic manager that had this extraordinary track record. And they say when you meet the right person, you don't need to meet everybody else in the world to compare them against. And when I met Madhu in business, he really stood out as an extraordinary fund manager for a number of reasons. He's done Indian equity now for over 30 years. He has an extraordinary track record. I've never met any fund manager in the world with a track record as good in public equity over such a long period of time. I've never met anyone with as much passion. He is, as passionate and hungry today, in his mid-50s as he was 15 years ago. And above all, he has this huge respect in the Indian corporate sector. Every business owner, every founder, every media channel, every company knows him as this guy that has just had extraordinary success in the Indian capital markets. And so we formed a bond when we first met, actually 15 years ago. And that, if you think back in time, I'm not Indian, I'm English, and I was one of the few foreigners that was going to India every couple of months, with a big empty notepad, asking lots of questions, building a big conviction on the direction and the trajectory of this market. And we went through many years of that. I did a lot of work with him when he was at Reliance, various partnerships and things. But in the end, Madhu sold that business. They sold that business to a big Japanese player. Madhu came out. He handpicked some of the senior people and set up his family office. And we had been in very close contact throughout this period. And we had a shared vision that we wanted to build a platform where we would manage money for some of the most successful and wealthiest families around the world. Now, you might say, why is that? Because, we could, Madhu could easily just build a big domestic business with his brand. But what he was attracted to in the international market, which kind of married with my thinking too, was that everything that India is doing today is happening in the rest of the world, or has already happened in the rest of the world. Every sector that is going through transformational growth in India today is already large in America, in Canada, in Europe. And if we can meet the families that have created the best wealth in all these different sectors around the world, they should have an allocation to India because it's the fastest growing market, so they should deploy capital there. We can obviously do that for them. But at the same time, we can learn what were the trigger points in their success in building the most successful logistics companies or healthcare companies or shipping companies or financial companies in the different markets around the world. And we can take that knowledge, we can take those insights, we can connect that with the businesses in India, and that can enrich the companies that were invested in India. So that was the vision really, to build that platform together and to combine our respective qualities and skill sets.
Great. Well, I think I hope the listeners can understand this kind of insight into how a fund manager and the investment manager work together is very rare. As a matter of fact, I think in the last 25 years, what you just described, I don't think I've read more than 2 or 3 times the kind of relationship guidance that you gave. Extremely valuable. But just riffing off the last answer that you gave, Spike, um, walk us through some examples of what makes this dynamo running on 2 great cylinders. Give us some examples of how this works in terms of stock picking.
So I think the first thing is, we're not too worried what anyone else is doing. We don't look at, what the index thinks. We don't look at what the peer group thinks. I mean, obviously we take reference, but, our primary objective is can we create a very attractive risk reward asymmetry? We want to get a very attractive risk reward set up in our portfolio. So, first of all, and obviously Madhu's been doing this for over 30 years now, for 34 years. So, that experience counts for a lot. When you look at something, you're looking at it through more than 3 decades of having seen it all before. But first and foremost, we like to see that tailwind in play. Can we identify an opportunity, a sector that's going to become much larger over time? And a sector and companies within that sector where we can generate disproportionate returns, and where that risk reward asymmetry is very much skewed in our favour, and where we really understand the businesses that we're picking. So we're not interested in following the herd. We like to be leaders in what we do. So maybe I'll give you 2 or 3 examples, and that will I'm not going to say we look at balance sheets and cash flow and all these things because that's taken as read. But India today, one big sector of opportunity is infrastructure. We're currently in a 5-year plan where they're spending $2 trillion on infrastructure. It's everything. It's roads, it's railways, it's bridges, it's airports, it's ports, urbanization, metros. The whole shebang, and that's obviously $2 trillion. I don't know any other country in the world spending that much on infrastructure. But 3 years ago, nobody wanted to invest in infrastructure because the view was that there were too many headwinds. The government wasn't, so a number of years back, the government wasn't approving projects quickly enough. They were getting stuck. Interest rates were high, so it was expensive to finance infrastructure projects. The banks weren't lending for a period of time, which I'll come to, and capex had been a bit high, so the headwinds were there. But we looked at it 3 years ago and we said, actually, the market perceives headwinds, but actually we're looking at them in our rear view mirror now. So the $2 trillion spend was committed. Banks had selectively started to lend again post their cleanup. Interest rates had come down a lot, so the cost of borrowing was lower. And we looked at a company called Larsen and Toolbro. Now, it's a Nifty 50 name. We're not known for necessarily holding something because it's a Nifty 50 name, but it was 20 billion market cap. And it had a 20-year track record. It had already made 10,000% return, which was 100x over 20 years. So we looked at this and we said, well, if this is the largest, longest serving, best performing infrastructure stock, and no one wants to buy infrastructure companies and they're spending 2 trillion, it's fairly obvious that this company is going to win more than its fair share of the projects because it's the biggest, it's got the best track record, it's most likely to better get the finance, etc., etc. And we bought this company at 20 billion. Now this wasn't investing in some sort of medical breakthrough that may or may not work out. This was a simple company that was woven into the growth fabric of the India story. And we bought it at 20 billion. We sold it after 2.5, 3 years at 60 billion. So it was 3x, but it was a relatively low risk pick for us. And then at the end of that period, that's when we saw the rest of the market starting to come in. If I was to give you another sector, when you look at vast majority of the money that comes into India historically is coming to the big Nifty 50 names. A lot of it's been ETF money. A lot of it's been a component of a broader emerging market portfolio. And the financial sector's typically been about 25% of the index. And most of that money is in the private sector banks. So really good businesses in the private sector bank sector. But over the last 5 years, they haven't made money for investors. They've been priced to perfection, shall we say, 3.5, 4 times price to book. And 2 or 3 of the biggest ones that you'll see in every India fund have got more than $100 billion of foreign capital in them, but they just haven't made returns, even though they're good businesses. We looked at public sector banks now, not because it was a bad sector, but it was a sector that had gone through considerable change that we thought looked very, very appealing. I'll just give you a few examples. 10 years ago, there was no bankruptcy code in India. You could literally fold a company, walk away from the debt and start again next door, and the bank was left with a loan. So they brought in a bankruptcy code. And for 2015 to 2022, over that 7-year period, the banks couldn't pay out their profits. They had to provision against their loan books. So whatever they made had to be cash provisions for their loan books. Now that was a $200 billion provisioning. The market cap of the financial sector was $1 trillion, and 200 billion was provided for. So that's 20% of your market cap provided against your loan book. So I don't know any country in the world that has ever had a banking cleanup on that scale. So suddenly, 3.5 years ago, public sector banks, had the best loan books that you could see out there. There were issues, historically with governance, but the government sent a lot of people to jail. They made examples of a lot of people, where there'd been bad practice, and the mindset changed overnight. The governance became good, the practices became proper. Balance sheets were highly strengthened, and then there were just softer things like the government said, we're only going to pay money to you if you have a bank account. In less than 60 days, the public sector banks opened up 350 million new bank accounts. That's like every single human being in the United States or in Europe opening up a bank account in less than 60 days. And this was with the public sector banks. So you had all these things happening, as well as the fact that post the demonetization a few years ago, where they scrapped the cash and created this formal economy pretty much overnight. You've had hundreds of millions of people coming into this formalized economy, opening bank accounts, and obviously the Indian population is hundreds of millions of people getting wealthier every year, and per capita income is going to double in the next few years. This all plays well for the bank. So anyway, part of it was the structural story. Part of it, though, was rather than going with the herd, which was to own private sector banks, they were trading on 3.5, 4 times price to book, and we bought public sector banks on 0.3, 0.4 times price to book, so a tenth of the valuation. And in 12, 15 months, we made 2.5, 3x, and then we sold. And now they're trading on 3 times price to book. But at the time, we bought them at 0.3, 0.4, sold them below 1 time, and made 3x. So, and if I was just to give you a final example, and this may appeal to the younger listeners, we're all worried about climate change today. We're all very interested in global warming, and one theme that will be very large for the world is going to be clean energy, a transition to clean energy that doesn't pollute the atmosphere. Now, this is a challenge for India because, as you know, 1.5 billion people that need electricity, that need power. You can't be producing coal forevermore. You don't want to be importing oil forevermore. So India is top 3, top 4 in the world on building clean energy. And within the next 5 years, nearly 40% or approximately 40% of all of India's electricity production will come from solar energy. And we looked at this sector and we said that's a lot of solar energy to provide electricity for hundreds of millions of people in such a short time. And the one thing that we realised was that you cannot generate electricity from solar power without having transformers. And Elon Musk said the world's going to run out of transformers. And so we did a lot of work on the transformer sector. We picked the second biggest company in the industry. We did a lot of work. We spoke to a lot of experts, and we went to that company and we said, you should have an additional stock market issue. We invested into that, and that was a fabulous return. We made several times our money in a few months. But this is a long-term theme where you can indirectly play clean energy transition. So, but again, it's just about finding a big theme, doing a lot of bottom-up research, picking the best companies. Invariably, we will have known them for many years, getting in at a good price, and just being a couple of years ahead of the foreign investors, and then you can make your return. And by the time we're ready to sell, there's lots of willing buyers standing behind us. Yeah,
very good. So let me move into perhaps a bit more topical aspects. Emerging markets, especially when they are on a tear, as what we have seen, it does get a bit of frothy feeling, and but there's a huge IPO pipeline, so to say, and then besides that, obviously you had certain blips, if I may. With the Hyundai IPO and the regulators starting to take a closer look, looking at the options trading, so on and so forth. Your thoughts about this? Is this a short-term blip, or do you think that this is actually going to be just a blip? The trajectory is solid, going up in the longer term.
I think so. First of all, there's been a fair bit of focus, well, not just on India, but on markets generally, where there's pockets of expensive stocks. And I think the natural question that people have in India, because it's performed better than most markets over the last few years, is it too expensive? Are the valuations too high? And October, the last month, was a bit of a pullback in the market. I mean, nothing serious, but a bit of pullback. And there was heavy foreign selling, and that was for a variety of reasons, not just India. But I think there's two things to look at. One is in every stock market, including the US, there are some sectors and some companies that are on crazy frothy valuations, and that is also true. It has been true in India. Some of the defense stocks, etc., one or two sectors have been a bit expensive. Equally, there's lots of companies that are very attractively valued. And if you take the valuation metrics of India today, compared to the last 10 years or so, it's actually bang in range. It's not overvalued relative to its longer term average. India is a big growth market. It's not a cyclical story. It's not dependent on 2 or 3 commodity stocks. It's not dependent on 1 or 2 energy stocks. Every sector across, this is a very old, it's a 150-year-old stock market. It's got more companies listed than any other exchange in the world. It's highly regulated. It's got lots of liquidity. It's got IPOs coming every year. And it's the 4th largest stock market in the world today. It's a $5 trillion. Now, when Madhu started investing in markets, just over 30 years ago, it was a 200 billion economy and a 150 billion stock market. Today, it's a 4 trillion economy and a 5 trillion stock market. It's the 4th largest stock market in the world, and it's forecast to double in the next few years. So value, and the thing is, it's got such big structural growth drivers. So first thing is valuation of the market as a whole is okay relative to it. It's in range with its long-term average. Second, it's got more growth than any other major market in the world, whether that's economic growth, whether it's corporate earnings growth. And again, that's structural. And the third thing to look at is that is the certainty that comes with the growth. You can see very, very high degree of certainty in the corporate earnings for a long way forwards. I can't find that in European companies quite so well. So, that really, we have to not just look at the price, but we have to look at the growth. And I personally think it's justified. But the other thing is, we're not investing in a stock market, or at least we're not. If you buy an ETF, you're investing in a stock market. We're investing in a market of stocks. So, what we've been able to consistently do over the last few years is to find companies. I just gave you an example of the public sector banks trade. It didn't matter that 25% of the index was in banks on 3.5 times price to book, because we were paying a tenth of that valuation with very, very high growth. So in every sector, there are companies that are cheaper than the market, that are growing substantially faster than the market. And that's the risk reward asymmetry that I referred to at the beginning. So it's good when you do get periods like we've had this last month where there's a bit of pullback and market, the froth comes off a bit where it's been there. It reminds everybody that that things don't just go up in a straight line. But I think the size of the growth, the breadth and depth of the growth, and the certainty that comes with it for people that are on the ground and know what they're looking at. I don't know any other market on a risk-adjusted basis that looks so attractive.
Mm. So let's pick up on something that you mentioned, and I'm conscious of the time. You talked about there's a bit of a sell-off from the foreign investors, and especially the institutional play, FIIs. So obviously, there are several reasons, and I would love to hear your thoughts about it. But one of the factors that the foreign investors are quite interested in is the FX depreciation.
Yeah.
So would love to hear your thoughts about the recent sell-off, but also the medium and long-term perspective of the institutional investor into Indian equities. And if you can also say a few words about FX and how do you account for it?
Yeah. So first of all, on the foreigners, 10 years ago, India was very sensitive to foreign investment coming in and out. Foreigners were coming into the market, it went up and it went down, and the ranges were more, wider. But what's happened in India is, you've got obviously more than 1 billion people. The savings rate is very high. Historically, that money used to go into predominantly property and gold. Tiny amount went into the stock market, and because of formalization of the economy, everybody now being tracked, having a bank account, being digital identification, registered for tax, clean up in the property sector. There's a lot of money now domestically going into the stock market, and a multiple of the bulk of the money coming into the Indian stock market today is actually domestic investors. And that's really sticky money. It's millions of people doing small monthly savings. They call it systematic investment plans. You'll be familiar. And so what foreigners think and do is becoming less of an impact on the Indian stock market. And domestic investors will become substantially bigger over the next few years as they put more and more money in to stock market. From a foreigner perspective, why have they taken money out? It's been a variety of reasons. It's been some valuation sensitivity because most of the foreign money is in ETFs, and that's gone into the more expensive names that don't have the same risk-reward dynamics that we seek. Some of it's because there was a bit of a China stimulus. Some of it has been nervousness around stuff happening in the Middle East, US elections coming up, and all these types of things. It's been for a variety of reasons, but fundamentally, if India is the fastest growing major economy in the world, which everyone's agreed on, foreign money will chase that growth. And so, in the medium long term, we'll see commitment. As far as currency, my simple answer on that is whenever a country is healthy and is growing, the currency outlook is good. And in every market, there's been times in the past where currency's not worked so well when the countries have not been so strong. But India today, the economic growth, the corporate earnings growth, it's got very, very substantial foreign exchange reserves. There's this big shift. America and Europe is diversifying its supply chain from China to India for manufacturing, whether that's electronics, iPhones, pharmaceutical, and that's going to create a lot of exports, which is good for the currency. There are so many things happening in India that will drive a strong domestic currency over the next few years. I think that when you invest in any market outside of your own, you have to accept there can be some currency depreciation. But I think the outlook for the Indian currency is very strong, and I think the growth will greatly outweigh any currency depreciation that you experience.
Great. So thank you very much, Spike. As you can see, and you heard from him, somebody who has got long experience, years and years and years, a great operating model, a fantastic track record of actually investing properly, some good, well thought out, cogent reasons behind both the Indian market, the various investors, the stock picking mechanism, and the prognostication for the future. I'd just like to point out a couple of things. One of the reasons why I'm personally this bullish is because when you compare and take a longer term perspective as a macroeconomist of how national economies develop, I think what has the first thing, as Spike mentioned previously, the Joe public, if you will, or in India was putting it into real estate and gold. But now they are moving into financial instruments. They are starting to move into funds. They're starting to move into derivatives. This has actually moved across the tipping point. Now, why do we say the US market is so good? The reason why the US market is so good for new financial products is because you've got a very broad base of consumers who are happy to explore sophisticated financial instruments. And in case of India, I think the fact that we have crossed that tipping point, I think somebody was talking about 200 million accounts or something like that, that people have set up, is promising a good future for the country. Anyway, quite a lot of good discussions. Spike, as usual, absolute pleasure speaking to you. Thank you very much for your time.